In this video, we're going to take an in-depth look at one of the most significant financial events in modern history, the global financial crisis, GFC, of 2007-2008. This crisis shook the entire world, leading to massive economic downturns, widespread job losses, and a global recession. But what exactly caused this crisis? How did it unfold, and what lessons can we learn from it? Let's dive into it. The build-up. Housing market boom. The seeds of the global financial crisis were sown in the years leading up to 2007, during a period of rapid economic growth. In the early 2000s, housing markets in the US and other countries were booming. Low interest rates, rising home prices, and relaxed lending standards made it easier for people to buy homes, even if they couldn't afford them. Mortgage lenders began offering risky subprime mortgages, loans to people with poor credit history or unstable financial backgrounds. Many of these homeowners couldn't afford the mortgage payments, but they were still approved due to lax regulations and the assumption that housing prices would continue to rise. Banks and financial institutions also got involved by bundling these risky mortgages into mortgage-backed securities, MBS, which were sold to investors around the world. These securities were often seen as safe investments, but they were anything but. So, what seemed like an economic boom was actually a financial time bomb waiting to explode. The role of banks and financial institutions. As more and more mortgages were being handed out to high-risk borrowers, banks and financial institutions became increasingly involved in risky behavior. To make a profit, banks started to bundle these risky mortgages into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These were then sold to investors, who believed they were safe investments. The problem was that the banks, hedge funds, and investment firms that were trading these MBS and CDOs didn't fully understand the risks involved. Many institutions were overexposed to these securities without realizing how deeply interconnected they were with the housing market's fate. At the same time, financial products like credit default swaps, CDs, were being used to bet on the failure or success of these securities. This was essentially turning the global economy into a massive game of speculation. The housing bubble bursts in 2006. The US housing market began to show signs of trouble. Home prices, which had been rising steadily for years, started to fall, and mortgage defaults began to increase. As home prices dropped, many homeowners who had taken out subprime mortgages found themselves underwater, meaning their homes were worth less than the mortgages they owed. This led to a wave of foreclosures, where homeowners were unable to make payments and banks began seizing properties. The value of mortgage-backed securities, tied to these homes, began to plummet. What followed was a snowball effect. As MBS and CDOs lost value, financial institutions that had invested heavily in them faced huge losses. This created a credit crunch. Banks became unwilling to lend money, which caused a major slowdown in economic activity. The collapse of major financial institutions. As the housing market collapsed and mortgage-backed securities lost value, some of the world's largest financial institutions began to crumble under the weight of their bad investments. In September 2008, the iconic investment bank Lehman Brothers declared bankruptcy, sending shockwaves through the global financial system. Lehman's failure was the largest bankruptcy in US history at the time, and it triggered a massive panic. Other banks and financial institutions that had similarly invested in MBS and CDOs, like Bear Stearns and Merrill Lynch, faced similar crises. The US government and Federal Reserve had to step in with emergency bailouts and interventions to prevent a total collapse. Banks were propped up with taxpayer money, and the global credit system was on the brink of collapse. Global economic impact. The crisis wasn't confined to the US. The global financial crisis spread quickly across the world, affecting markets, businesses, and economies in nearly every country. Stock markets around the globe plummeted, with major indices like the Dow Jones and FTSE 100 losing hundreds of billions in value. Unemployment rates soared as businesses cut jobs and factories shut down. People lost their homes, their savings, and their livelihoods. The global economy went into a deep recession. Consumer spending dropped, trade slowed, and many countries saw their economies shrink. The crisis also led to a loss of confidence in the banking system, with many people pulling their money out of banks. Government responses and bailouts. In response to the crisis, governments around the world took drastic steps to stabilize their economies. The U.S. government passed the Emergency Economic Stabilization Act in 2008, which authorized a massive $700 billion bailout to help stabilize the financial system. This allowed the government to purchase distressed assets from struggling banks and inject capital into the financial sector. Central banks, including the Federal Reserve and the European Central Bank, cut interest rates to stimulate borrowing and investment. They also provided liquidity to banks to ensure that they could continue to lend. Despite these efforts, the recovery was slow. The damage to global financial markets was profound, and it took years for many economies to fully rebound from the crisis. The long-term consequences of the crisis. The global financial crisis left a lasting legacy. First, the crash exposed major flaws in the global financial system, particularly the lack of regulation in the banking sector. Governments around the world enacted new rules and regulations to prevent another crisis, such as the Dodd-Frank Wall Street reform in the U.S. Second, the crisis contributed to a rise in income inequality. While many wealthy individuals and large corporations recovered quickly, millions of everyday people faced years of economic hardship. Finally, the housing market took years to recover, and global unemployment rates remained high for a long time. The world learned hard lessons about the dangers of speculative investing, deregulation, and the risk of relying too heavily on credit and debt. Key takeaways from the global financial crisis. So, what can we learn from the global financial crisis? Here are some key takeaways. 1. Over-leveraging. Excessive borrowing, both by individuals and institutions, can lead to catastrophic results. 2. Regulation matters. Effective oversight of financial markets is crucial to prevent reckless behavior. 3. Risk management. Speculating on risky investments without understanding the underlying risks can lead to disaster. 4. Global interconnectedness. In today's world, the financial system is highly interconnected, and a crisis in one country can quickly spread to others. The global financial crisis of 2007-2008 was a wake-up call for the world. It exposed the vulnerabilities of the global financial system and led to significant changes in regulation and economic policy. Though the road to recovery was long, many economies have now bounced back, but the scars of the crisis remain. What do you think about the global financial crisis? How did it impact your life? Let us know in the comments below. If you enjoyed this video, be sure to like, subscribe, and hit the bell icon for more financial history and insights. Thanks for watching, and we'll see you in the next video.